Have you ever noticed how the price of something you love, like say your favorite craft beer, or maybe that specialized software you use, suddenly shifts, seemingly without warning?
Oh, yeah.
Or how a brand new competitor, maybe offering something totally unexpected, can just pop up and kind of disrupt an entire industry overnight.
Absolutely. It feels like there are these powerful, unseen currents, right, shaping the economic world around us.
Exactly. And that's precisely what we're going to dive deep into today.
Yeah, we're pulling back the curtain on those fundamental, often invisible forces that sculpt, well, pretty much every business decision, every market interaction.
It's a big part of our daily lives, really.
It is. Think of it as understanding the core mechanics, how things are bought, sold, produced, and how businesses, strategize to survive and thrive within all these dynamics.
That's right. And our mission here in this deep dive is to give you a genuine shortcut to being well informed on these sometimes pretty intricate market influences.
We've gathered insights from a whole range of sources, blending those foundational economic principles with some higher-level business strategy.
Yeah, we're not just going to define terms, are we? We want to illuminate the connections, the maybe surprising implications, and hopefully deliver some of those aha moments.
Making these concepts clear, relatable,
Mm.
and honestly, genuinely fascinating. And practical, too.
Get ready to see the world through maybe a new economic lens. Okay, let's unpack this a bit. Before we get into the real nitty-gritty of market movements, maybe we should briefly touch on the difference between microeconomics and macroeconomics.
Good idea. It's not just about big versus small, though that's part of it. It's more about the lens we're using.
Right, the perspective.
Exactly. So when we talk about macroeconomics, we're zooming way out, big picture stuff.
The 30,000-foot view.
Precisely. This field looks at how human behavior affects highly aggregated markets. Think an entire economy's total output of goods and services, or the overall labor force for a nation.
National inflation rates, unemployment figures, that kind of thing.
Yep. The kind of large-scale data points that policymakers and central banks really focus on. Things that influence entire nations, even global economic trends.
So the big economic tides. Got it.
Now, microeconomics, and this is our main focus today, takes a very different approach. It drills down.
Down to the individual level.
Pretty much. It examines how human behavior influences outcomes within much more narrowly defined units. So we're looking at the choices of a single consumer, maybe the budgeting decisions of one specific household, or the strategic moves of an individual company.
Like instead of the whole car market, maybe just the market for electric pickup trucks from one specific brand.
Exactly. Or, dissecting the market for a very specific type of organic fair trade coffee rather than all beverages.
Yeah.
Our conversation today is really rooted in understanding these microeconomic forces.
And that gives us insight into the dynamics hitting individual businesses and, well, our own economic decisions as consumers, too.
That's the goal.
Perfect. So let's start with one of the most foundational rhythms of any market: demand. It's definitely more complicated than just, wanting something, isn't it?
Oh, absolutely. You'd hit a key point there.
I mean, I could want my own private spaceship, but that doesn't exactly create economic demand, right?
Oh, right. That perfectly highlights the crucial difference. In economics, demand isn't just desire. It's desire backed by actual purchasing power. You have to be willing and able to buy.
Willing and able. Okay.
So the demand curve you often see in textbooks, it illustrates the maximum quantity of a specific good or service that consumers are not only willing but also able to purchase at each and every possible price point.
For a specific thing, like that coffee, not everything in the economy.
Exactly. And it's always under that assumption of ceteris paribus, or all else being equal. We're trying to isolate just the effect of price changes on buying behavior.
So for my spaceship, the willingness might be there, but the able to purchase part is lacking?
Just a bit. So no real economic demand there.
Got it. So the demand curve shows the relationship across all possible prices. What about if we're just looking at one specific price?
That's where the term quantity demanded comes in. Quantity demanded refers to the precise amount of a good or service that people are willing and able to buy at a given single price. It's one specific point on that demand curve.
Okay, a point on the curve. Now, what happens if only the price of that specific thing changes? Say the coffee shop lowers the price of that artisanal blend. Does that shift the whole curve?
That's a really vital distinction. If only the price of the good itself changes, we call that a change in quantity demanded.
Okay.
And graphically, this is shown as a movement along the existing demand curve. Think of it like walking up or down a fixed path. The path itself doesn't move, just your position on it.
So the price of the coffee drops, people buy more of that coffee, they move down along the curve to a higher quantity.
Precisely. Movement along the curve is only about a price change for that specific good.
But what if the whole path moves? The entire curve shifts location.
Ah, that is a change in demand. This happens when the amount people want to buy changes because of anything other than the price of that specific good.
Anything else?
Yes. This causes the entire demand curve to shift, either left, a decrease in demand, or right, an increase in demand. It's like the whole path suddenly moves to a new spot. For example, if a big health study comes out saying coffee is bad for you, the entire demand curve for coffee might shift inwards to the left. People want less coffee overall, regardless of the price.
Oh, okay. That distinction is clear now. Movement along versus shifting the whole curve. Now, here's where it gets really fundamental, right? The basic law of demand. It feels like it's just everywhere.
It really is. The fundamental law of demand states there's an inverse relationship between the price of something and the quantity demanded.
Inverse meaning they move in opposite directions.
Exactly. Put simply, as the price goes up, the quantity people are willing and able to buy goes down. And if the price drops, the quantity demanded goes up. It's a core principle you see playing out constantly.
But why? What are the underlying reasons for this? Why do we react this way to price changes?
Good question. There are two main economic forces, or effects, driving this. The first is the substitution effect.
Substitution, like finding an alternative.
Exactly. When the price of a good falls, consumers tend to buy more of it relative to other similar goods because it's now comparatively cheaper. They substitute towards the cheaper good.
And if the price goes up?
They buy less, substituting away from it towards alternatives that now look like a better deal. If Pepsi gets cheaper, some Coke drinkers might switch.
Okay, makes sense. What's the other effect?
The other one is the income effect. This is a bit different. It says that when prices drop, assuming your actual income stays the same, your purchasing power, your real income, effectively increases.
How does that work? My paycheck is the same.
Right, but your paycheck can now buy more stuff overall because things are cheaper. You feel, in a sense, a bit richer.
My money stretches further.
Exactly. So, for example, if gas prices fall significantly, you have more money left over after filling your tank. That increased purchasing power might lead you to buy more of all kinds of things, including potentially more gasoline, but also maybe more snacks at the gas station, or save it for something else. Your overall ability to consume has gone up.
So substitution is about relative prices between goods, and income effect is about overall purchasing power changing due to a price change.
Got it. Those are the two key drivers behind that downward sloping demand curve.
Okay, so we know price changes cause movement along the curve. But what about those factors that shift the entire curve? What makes people want more or less of something completely separate from its price tag?
Right. These are the demand shifters. There are several important ones. First up, changes in wealth.
Like people getting richer or poorer overall.
Exactly. If people, on average, become wealthier, maybe the stock market has a great run, or house prices go up, their demand for many goods, especially things considered luxuries or non-essentials, tends to increase.
So the demand curve for sports cars or fancy vacations might shift to the right.
Very likely, yes. People feel more comfortable spending. Conversely, during a recession, demand curves for those items often shift left.
Makes sense. What's next?
Next is changes in the price of related goods. This one splits into two crucial types we need to understand: substitutes and complements.
We touched on substitutes already. If the price of a rival good goes up,
Then the demand for the original good increases, shifting its curve to the right. It becomes the relatively cheaper option. Think if the price of butter goes way up, the demand for margarine might increase.
okay. And complements, what are those?
Complementary goods are items that are typically used together. Think hot dogs and hot dog buns, or printers and ink cartridges.
Things you consume jointly.
Yes. So if the price of a complementary good decreases, the demand for the original good typically increases. If printers suddenly become very cheap, people might buy more printers, and consequently, the demand for ink cartridges, the complement, will shift to the right.
Ooh, that's a good one. Cheaper printers drive ink sales?
It's a common strategy, actually. Sell the razor cheap to sell more blades.
Clever. Okay, what else shifts demand?
Another big one is changes in consumer income. Not wealth, which is accumulated assets, but actual income flows. Generally, for most goods, what we call normal goods, an increase in consumer income shifts the demand curve to the right.
People earn more, they buy more stuff. Seems straightforward.
Usually, yes. Think about people getting year-end bonuses. You often see a temporary surge in demand for consumer electronics, restaurant meals, things like that.
Yeah, definitely see that around the holidays.
Then there are changes in consumer tastes or preferences. This is huge. Fads, trends, new information, cultural shifts, they can drastically alter demand.
Like suddenly everyone wants to wear vintage clothes or a celebrity endorses a certain brand.
Exactly. If a popular health influencer starts promoting kale smoothies, the demand curve for kale might shift significantly to the right, purely based on changing preferences, not price or income.
The power of trends.
It's massive. Another factor is changes in consumer expectations. What people think will happen in the future matters now.
How so?
If consumers anticipate that the price of a product is going to rise significantly soon, their immediate demand for it might increase right now. They try to buy it before the price hike.
Ah, like stocking up if you hear gas prices are about to jump.
Precisely. That expectation of a future price increase shifts the current demand curve to the right. The same happens if they expect a shortage.
Very relatable, especially after the last few years.
Isn't it just? And finally, a straightforward one. Changes in the number of buyers in the market.
More people means more demand.
Basically, yes. If the population of potential buyers for a product grows, the demand curve will shift to the right. A clear example is the aging population in many countries. As the number of seniors increases, there's a natural rise in demand for things like healthcare services, retirement communities, and certain pharmaceuticals. The market size itself is expanding.
That's a really comprehensive look at the demand side. So many factors pulling it one way or the other. Now, let's flip the coin and talk about supply. What motivates producers?
Excellent transition. Yes, supply is the other half of the market equation. Just like demand, it has its own curve and determinants. The supply curve shows the maximum quantity of a specific good or service that sellers are willing and able to produce and offer for sale at each and every price.
Willing and able again, but this time for production.
Exactly. It maps out the producer's readiness to create and sell at different price points. And again, it's for a specific good in microeconomics.
Okay. And quantity supplied. Is that the same idea as quantity demanded?
Analogous, yes. Quantity supplied is the specific amount producers are willing and able to bring to market at one given price. A single point on the supply curve.
So if only the price changes, say, the market price for coffee beans goes up, that's a change in quantity supplied, a movement along the supply curve.
Correct again. A change in quantity supplied results only from a change in the product's own price, causing movement along the existing supply curve. The curve itself stays put.
But a change in supply is when the whole curve shifts?
Yes, a change in supply happens when the amount supplied changes due to anything other than the price of that specific good. This causes the entire supply curve to shift left, decrease in supply, or right, increase in supply.
And is there a fundamental law of supply, like the law of demand?
There is, and it generally works in the opposite direction to demand. The law of supply states that price and quantity supplied are usually positively related.
Meaning higher prices lead to more supply.
Generally, yes. Higher prices typically incentivize sellers to produce and offer more for sale because it's potentially more profitable for them to do so.
Okay, so what makes a company suddenly want to produce more or less, even if the selling price hasn't changed? What are those external factors that shift the entire supply curve?
Several crucial factors drive these shifts in supply. First, let's consider changes in price expectations of the supplying firm.
So what the company thinks prices will do in the future.
Exactly. If a firm expects the selling price of their product to fall significantly soon, they might actually increase their supply now to sell as much as possible at the current higher price.
Ah, like selling off inventory before it loses value.
Precisely. Imagine a farmer who hears that a huge harvest is expected next season, likely driving down crop prices. They might sell off more of their current stored grain today before that price drop hits. This shifts the current supply curve to the right.
Smart move. What else?
A huge one is changes in production cost the price of inputs.
Like raw materials, labor, energy.
Yes, if the cost of critical inputs goes down, it becomes cheaper to produce each unit. This increases profitability per unit, making firms willing to supply more at any given price. So lower production costs shift the supply curve to the right.
And higher costs shift it left, making them supply less.
Exactly. Think about a sudden spike in oil prices. That increases transportation and energy costs for almost everyone, likely shifting many supply curves to the left.
Okay, costs are key. What else?
Then there are changes in the price or demand for other goods that the same firm produces. Many companies aren't single product firms.
Right. They might make several related things.
Yes. So if the demand for one of their products collapses, they might shift their resources, machinery, workers, factory space, towards producing more of another product in their lineup that's suddenly more profitable or in higher demand.
Like a car company shifting production from sedans to SUVs if SUV demand surges.
Perfect example. The supply curve for their SUVs would shift to the right, while the supply curve for their sedans might shift left as resources are reallocated.
Resource allocation based on market signals makes sense.
Also, changes in subsidies or taxes have a direct impact.
Government intervention again.
Yep. Government subsidies paid to producers effectively lower their costs, encouraging them to supply more at each price, shifting the supply curve right. Think subsidies for renewable energy production.
And tax.
Taxes generally increase production costs or reduce profitability, leading firms to supply less, shifting the supply curve left.
Yeah.
Consider a new tax on cigarettes. Tobacco companies would likely reduce their supply.
The government's hand is definitely visible there.
And finally, a really powerful shifter. Changes in production technology.
Innovation.
Yes. An improvement in technology almost always leads to increased efficiency, lower production costs per unit, or both. This makes firms willing and able to supply more at every price level.
So a new invention that makes producing solar panels cheaper?
Would cause the supply curve for solar panels to shift significantly to the right, leading to more panels being produced and likely lower prices for consumers. Technological progress is a major driver of increased supply over the long run.
Okay, so we've seen how demand pulls and supply pushes reacting to all these different factors, but what happens when they actually meet in the market? Where does the price settle?
This brings us to the crucial concept of market equilibrium. It's the point where the forces of supply and demand are in balance.
Balance meaning?
Yeah.
What exactly?
It means a price has been reached where the quantity of a product that producers are willing and able to supply is exactly equal to the quantity that consumers are willing and able to demand. There's no inherent pressure for the price to change at that specific point.
The intersection point on the supply and demand graph.
That's the one. It's often called the market clearing price because at that price, the market is theoretically cleared. There's no excess supply left unsold and no excess demand left unsatisfied.
So no frustrated buyers who can't find the product and no worried sellers with warehouses full of unsold stuff. The sweet spot.
That's the idea of equilibrium. It's the market's natural resting point, assuming no external shocks.
But let's be real, prices aren't always perfectly at that equilibrium point, are they? What happens when the actual price is, say, too low?
Right. When the prevailing market price is set below the equilibrium price, you get a shortage.
A shortage, meaning more people want it than is available.
Exactly. At that artificially low price, the quantity demanded by consumers exceeds the quantity suppliers are willing to produce. Think concert tickets priced way below what people are willing to pay. They sell out instantly, and many fans are left empty-handed. That's a shortage.
Leads to scalping and long lines sometimes.
Often, yes. Or empty shelves in stores. Now, what if the price is too high, above equilibrium?
Then I guess producers make too much.
Precisely. If the price is set above the equilibrium level, the quantity supplied by producers will exceed the quantity demanded by consumers. This results in a surplus.
Like unsold cars sitting on the lot or clearance racks full of last season's clothes.
Perfect examples. Producers are making more than people are willing to buy at that higher price, leading to unsold inventory piling up. This pressures sellers to lower prices to clear out the excess stock.
So shortages push prices up towards equilibrium, and surpluses push prices down towards equilibrium.
That's the natural market adjustment mechanism, yes.
Okay, but markets aren't static, right? We just spent ages talking about all those factors that shift the demand and supply curves themselves. What happens to the equilibrium point, that price and quantity, when one of those curves does shift?
Ah, yes, the ripple effect. When either curve shifts, the old equilibrium is disrupted, and the market moves towards a new equilibrium price and quantity. Understanding these shifts is key.
Okay, let's take it step by step.
Yeah.
What happens if demand changes? Say demand increases, the curve shifts right.
Okay, if demand increases, curve shifts right, maybe because of a positive health report about a product, then both the equilibrium price and the equilibrium quantity will increase.
Why both?
Because more people want the product at every price. The demand shift, they bid up the price. And seeing that higher price, producers are incentivized to supply more. So you end up with a higher price and more units being bought and sold at the new equilibrium.
Okay, demand up, Price up, quantity up, makes sense. What if demand decreases, shifts left?
Then the opposite happens. If demand falls, say a fad dies out, both the equilibrium price and the equilibrium quantity will decrease. Less interest means prices fall and producers cut back on production. Lower price, lower quantity sold.
So demand shifts move price and quantity in the same direction. That's a helpful takeaway.
It is. Now let's look at supply shifts. What if supply increases? The curve shifts right, maybe due to better technology. If supply increases, shifts right, the equilibrium price will decrease, but the equilibrium quantity will increase.
Wait, price down, quantity up. Why?
Because producers are making more efficiently perhaps. To sell all that extra product, they generally need to lower the price to entice buyers. But because more is available and the price is lower, the total quantity bought and sold in the market increases. Think about mass production making electronics cheaper and more widely available.
Okay, supply up, price down, quantity up. Got it. And if supply decreases, chefs left. Maybe a bad harvest.
Then you get the opposite. The equilibrium price will increase and the equilibrium quantity will decrease. Less is available, making it scarcer, which drives the price up. But because less is being produced overall, fewer units are bought and sold. Think oil shocks leading to higher gas prices and people driving less.
So supply shifts move price and quantity in opposite directions. Another good rule of thumb.
These basic effects are fundamental. But here's where it gets a bit more complex, but also more realistic.
Uh-oh. What happens when both curves shift at the same time? Does that happen often?
All the time. The real world is messy. And when both demand and supply shift simultaneously, the effect on either the equilibrium price or the equilibrium quantity can sometimes be indeterminate.
Indeterminate, meaning we just don't know.
Meaning we can't tell the direction of change for one variable without knowing the relative size or magnitude of the two shifts. Let's take an example. Suppose both demand and supply increase. Say, a new study shows electric bikes are great for fitness, increasing demand, and new battery tech makes them cheaper to produce, increasing supply.
Okay, so both curves shift right. What happens?
We know for sure that the equilibrium quantity will increase. More people want them, and more are being made, so definitely more e-bikes will be sold.
Right. More demand, more supply equals more sold.
But the effect on the equilibrium price is indeterminate. We don't know if it will go up, down, or stay the same unless we know how much each curve shifted.
How come?
Well, imagine the fitness craze is huge EE. Demand shifts right by a lot, but the battery improvement is minor. Supply shifts right only a little. In that case, the strong demand increase will overwhelm the small supply increase, and the price will likely go up.
Okay, demand pressure dominates.
But now imagine the opposite. The fitness aspect causes only a small bump in demand. Demand shifts right a little. But the new battery tech is revolutionary, slashing production costs. Supply shifts right by a huge amount. Now, the market is flooded with cheaper supply, overwhelming the modest demand increase. The price will likely fall.
Ah, so it depends entirely on which effect is stronger.
Precisely. The net effect on price depends on the relative magnitudes of the demand and supply shifts. The same logic applies to other combinations, like demand decreasing while supply increases, or both decreasing. One variable's change will be certain, the other will be indeterminate without more information on the size of the shifts.
That adds a whole new layer of complexity and explains why predicting prices can be so tricky.
It really does. Market analysis isn't just about direction, it's about magnitude.
Okay, sometimes the market's invisible hand, as Adam Smith called it, gets a very visible intervention from the government, right? Trying to set prices. What happens then?
Yes, governments often step in, usually with the intention of achieving some social or economic goal by imposing price controls. This means mandating prices that are different from the natural market equilibrium we just discussed.
And this usually leads to those imbalances we talked about earlier, shortages or surpluses.
Almost invariably, yes.
Yeah.
The two main types are price ceilings and price floors.
Let's start with price ceilings. What are they? Like a maximum price?
Exactly. A price ceiling is a legally mandated maximum price that sellers are allowed to charge. Crucially, for it to be binding or effective, it must be set below the natural equilibrium price.
Below equilibrium. Okay, and the goal is usually to make things cheaper.
Typically, yes. The intention is often to make essential goods or services more affordable for consumers, especially lower-income households. Think rent control or caps on gasoline prices during a crisis.
Sounds good in theory, but what's the economic reality?
The consistent economic effect of a binding price ceiling is that it causes shortages. Because the price is held artificially low, the quantity demanded by consumers far exceeds the quantity suppliers are willing to provide at that low price.
So the goal is affordability, but the result is unavailability.
That's often the unintended consequence. Take rent control in some cities. The mandated low rent makes apartments seem affordable, but it drastically increases the number of people wanting those few controlled units, while simultaneously discouraging landlords from building new units or even maintaining existing ones properly because the return isn't there.
Leading to long waiting lists, maybe poorly maintained buildings, or even black markets for apartments.
All of those are common outcomes of strict rent ceilings. It highlights the tension between social goals and market mechanics.
Definitely a tough balancing act. Okay, what about the opposite, price floors?
A price floor is a legally mandated minimum price that buyers must pay. For it to be binding, it must be set above the natural equilibrium price.
Above equilibrium. And this causes.
This causes surpluses. At the artificially high minimum price, producers are incentivized to supply more than they would at equilibrium, but consumers demand less because the price is higher. This leads to an excess supply, a surplus that can't find buyers at the mandated price.
And the classic example everyone talks about here is the minimum wage, right?
Yes, the minimum wage is a perfect example of a price floor in the labor market. The price is the wage rate, and the good is labor.
So the government sets a minimum hourly wage above what the market might naturally determine for certain low-skill jobs.
Correct. And the debate is intense. Supporters argue it's essential to ensure workers earn a living wage, reducing poverty and inequality, clear social policy goals.
But the economic argument against it.
Businesses, particularly those hiring many low-wage workers, argue that a higher minimum wage increases their labor costs. To cope, they might respond by hiring fewer workers, reducing hours, slowing expansion plans, or maybe investing more in automation to replace labor.
Leading to potentially higher unemployment among the very group the policy is intended to help.
That's the potential economic consequence highlighted by opponents. So you have this direct clash, the social goal of fair wages versus the potential economic outcome of reduced employment opportunities in certain sectors. It's complex, with real trade-offs, and economists continue to study and debate the actual magnitude of these effects.
It really shows how government intervention, even with noble intentions, can ripple through the market in unexpected ways, creating these persistent shortages or surpluses.
Okay, so we know prices change and demand and supply react. But how much do they react? Is it a huge swing in quantity demanded if the price changes a little, or just a tiny blip? That's where this idea of elasticity comes in, isn't it? Measuring sensitivity.
You've nailed it. Elasticity is a super important concept in economics and incredibly practical for businesses. It's essentially a measure of responsiveness or sensitivity. How much does one variable change in response to a change in another? Most often, we talk about how sensitive demand or supply is to a change in price.
Let's start with the big one, price elasticity of demand. How do we actually calculate that sensitivity, and what does the number tell us?
Okay, the price elasticity of demand, often shortened to PED, is calculated as the percentage change in quantity demanded divided by the percentage change in price. Percent change in quantity over percent change in price. Got it.
So if a price goes up by 10% and the quantity demanded falls by 20%, the PED would be negative 20% divided by plus 10%, which equals negative 2.
Why negative 2?
Well, because of the law of demand, price and quantity demanded usually move in opposite directions. Price goes up, quantity goes down, so the result is typically negative. But here's the thing. For practical interpretation, especially in business strategy, we often ignore the minus sign and just look at the absolute value. So in our example, we focus on the 2.
Okay, so the absolute value tells us the degree of sensitivity. How do we interpret that number like 2?
We compare the absolute value to 1. If the absolute value is greater than 1.0, like our 2NO, we say demand is elastic.
Elastic meaning stretchy, responsive.
Exactly. It means demand is very sensitive to price changes. A small percentage change in price leads to a larger percentage change in quantity demanded. Think luxury goods, items with many substitutes, or things that take up a large portion of a budget.
Okay, so elastic is very sensitive. What if the number is less than 1?
If the absolute value is less than 1.0, we say demand is inelastic.
Inelastic. Not stretchy, not very responsive.
Right. Demand doesn't change much, even if the price changes significantly. A percentage change in price leads to a smaller percentage change in quantity demanded. Think essential goods like basic food staples, gasoline in the short run, or life-saving medicines. People need them and will likely buy similar amounts even if the price goes up.
Can we walk through a quick calculation example from the sources?
Sure. Let's say a company raises the price of its product from $100 to $120. That's a 20% increase, $120, $100. And in response, the quantity sold drops from 1,000 units to 900 units. That's a 10% decrease.
905,000.
Okay, price up 20%, quantity down 10%.
So the PED is a negative 10% divided by plus 20%, which equals negative 0.5. The absolute value is 0.5.
And since zero point 0.5 is less than 1,
Demand is inelastic. In this case, the 20% price hike only caused a 10% drop in sales. The company has some pricing power here.
what if it's exactly 1?
That's called unit elasticity. The percentage change in quantity demanded is exactly equal to the percentage change in price. Demand changes proportionally. Okay, elastic, inelastic, unit elastic. What makes demand one way or the other in the real world? What are the main factors?
Two factors are really key. First, the availability of substitutes. The more substitutes there are for a product, the more elastic demand will be.
Because people can easily switch if the price goes up?
Exactly. If there are dozens of brands of breakfast cereal and one raises its price, consumers can easily switch to another. Lots of choice makes demand sensitive. If there are few or no substitutes, like for a specific patented drug, demand tends to be more inelastic.
Makes sense. What's the second factor?
The time period involved. Demand tends to become more elastic over a longer period.
Why more time means more sensitivity?
Because consumers have more time to adjust their behavior and find alternatives. If gas prices spike overnight, you might still have to drive to work tomorrow, inelastic short-term demand. But given 6 months, you might find a carpool, switch to public transport, or even buy a more fuel-efficient car, more elastic long-term demand. Time allows for adjustments. Okay, substitutes and time. Now, the crucial question for any business. Why do they care so much about this elasticity number? It's all about the bottom line, right? Total revenue.
Absolutely critical. Understanding price elasticity is vital because it tells a business how changing the price will affect its total revenue. Remember, total revenue is just price times quantity, PXQ.
So how does elasticity predict the impact on revenue?
It's straightforward once you get the hang of it. If demand is elastic, absolute value 1, a price increase will cause total revenue to decrease.
Wait, raise the price and make less money? How?
Because demand is so sensitive, the percentage drop in quantity sold will be larger than the percentage increase in price. You lose more sales volume than you gain from the higher price per item.
Okay, so for elastic goods, maybe lower the price.
Exactly. For an elastic good, a price decrease will cause total revenue to increase. The percentage gain in quantity sold will be bigger than the percentage drop in price. More people buy, offsetting the lower price per item. Think sales promotions on non-essential items. Got it. Elastic means lower prices might boost total revenue. What about inelastic goods?
If demand is inelastic, absolute value 1, a price increase will cause total revenue to increase.
Okay, this feels more intuitive. Raise the price, make more money.
Right, because demand isn't very sensitive. The percentage drop in quantity will be smaller than the percentage increase in price. You don't lose many customers, and the ones who stay pay more. Think price hikes on essential utilities or maybe cigarettes.
And lowering the price for inelastic goods.
A price decrease for an inelastic good will cause total revenue to decrease. People won't buy that much more, even if it's cheaper. So the revenue loss from the lower price per item outweighs the small gain in quantity.
And unit elastic.
With unit elasticity, a price change, up or down, leaves total revenue unchanged. The percentage changes in price and quantity exactly offset each other.
Wow. So knowing your product's elasticity is fundamental for any pricing decision. It's not just guesswork.
Not at all. It's strategic. Businesses spend a lot of effort estimating the elasticity of their products.
Okay, that covers demand elasticity. What about price elasticity of supply? Same idea, just for producers.
Pretty much the same concept, yes. Price elasticity of supply, PES, measures how sensitive the quantity supplied is to a change in the product's price. The formula is the percentage change in quantity supplied divided by the percentage change in price.
And it's usually positive, right, because of the law of supply?
Generally, yes. Higher prices usually lead to higher quantity supplied. We interpret the numbers similarly. Greater than 1 is elastic supply. Producers are responsive. Less than 1 is inelastic supply. Producers aren't very responsive. And 1 is unit elastic supply.
Can you give a quick example for supply elasticity?
Sure. Let's say a farmer increases wheat supplied from 500 bushels to 600 bushels when the price rises from $10 to $11 per bushel. Quantity supplied increases by 20%, 600, 500 bushel. Price increases by 10%, $10. So PES is 20%, 10 it's 2.0.
2.0 is greater than 1, so supply is elastic here. The farmer responded strongly to the price increase.
Exactly.
What makes supply elastic or inelastic in practice?
Key factors include how easy it is to store the product. Goods that can be easily stockpiled, like canned goods or manufactured components, tend to have more elastic supply. If prices rise, producers can just release inventory.
And perishables.
Things like fresh flowers or just-in-time components have very inelastic supply. You can't easily ramp up production or store them if prices spike. Another factor is production time.
How long it takes to make something.
Right. Goods that take a long time to produce, like building new airplanes or growing complex crops, have lower supply elasticity, especially in the short run. It's hard to quickly increase output even if prices shoot up. Industries that can adjust production levels quickly have more elastic supply.
Okay, elasticity of demand, elasticity of supply. Now, what if we want to know how the price of one product affects the demand for another one? Like, how does the price of coffee affect tea sales?
Now you're talking about cross-price elasticity of demand. It's a fascinating measure.
Cost price, because it
Yeah.
crosses between two different products.
Exactly. It measures the percentage change in the quantity demanded of good X divided by the percentage change in the price of good Y. It tells us how related two products are in the eyes of consumers.
How do we interpret the result? Does the sign matter here?
Yes, the sign is crucial. If the cross-price elasticity coefficient is positive, it means the two goods are substitutes.
Positive means substitutes. How?
Think about it. If the price of good Y, say coffee, goes up plus change in price, and the quantity demanded of good X, say tea, also goes up plus change in quantity, people are switching from coffee to tea. Both changes are positive, or both negative if price falls, so the ratio is positive.
Oh, price of coffee up, demand for tea up. They move in the same direction for substitute.
Got it.
What if the coefficient is negative?
A negative coefficient means the goods are complementary.
Complements used together, like printers and ink.
Right. If the price of good Y printers goes up plus change in price, the quantity demanded of good X ink cartridges go down, change in quantity. They move in opposite directions. Fewer people buy the expensive printers, so they need less ink. A positive change divided by a negative change, or vice versa, gives a negative result.
Okay, positive for substitutes, negative for complements. What if it's zero?
A zero coefficient means the goods are unrelated. A change in the price of one has no impact on the demand for the other. Like, the price of gasoline probably doesn't affect the demand for toothbrushes.
Can we run through another calculation example, maybe for complements?
Let's use the example from the sources. Sirloin steak and steak sauce. Suppose the price of sirloin steak increases from $10 to $12 per pound. That's a 20% increase. And this causes the quantity of steak sauce demanded to fall from 100 bottles to 5 bottles per week. That's a huge drop, a 95% decrease.
100.
Wow, okay. Price of steak up 20%, demand for sauce down 95%.
So the cross-price elasticity is negative 95% divided by plus 20%, which equals negative 4.75. Negative 4.75. Definitely negative, confirming they are complements. And the large number suggests they're strong complements.
Very strong complements in this example, yes. A rise in steak prices dramatically cuts demand for the sauce. This tells businesses how interconnected their product ecosystems might be.
Super useful for marketing bundles or understanding competitive threats. Okay, one last type of elasticity. What about our own income? How does a change in our paycheck affect what we buy?
That's income elasticity of demand. It measures how sensitive the quantity demanded of a good is to a change in consumer income. The formula is the percentage change in quantity demanded divided by the percentage change in income.
Percent change in quantity over percent change in income. Okay. And how do we interpret this one? Sign matters again?
Yes. The sign tells us if a good is normal or inferior. If the income elasticity coefficient is positive, it's a normal good.
Normal meaning what we'd expect. Income up, demand up.
Exactly. As income rises, people demand more of it. Most goods are normal goods: clothes, cars, restaurant meals, vacations.
Okay. So what if the coefficient is negative?
A negative coefficient signifies an inferior good.
Inferior. Sounds bad.
It doesn't mean the product is low quality, necessarily. It just means that as consumer income goes up, the demand for that good actually goes down.
Huh. Income up, demand down? Like what?
Classic examples include things like instant ramen noodles or maybe long-distance bus travel. When people have very low incomes, they might rely on these cheaper options. But as their income increases, they substitute away from these goods towards more expensive alternatives like fresh ingredients or flying.
Ah, so they trade up as they get richer, reducing demand for the inferior good. Got it. Can we do one last calculation?
Sure. Let's say someone's income increases by 10%. And as a result, their demand for attending professional sporting events increases by 40%.
Income up 10%, demand for sports tickets up 40%.
The income elasticity is plus 40% divided by plus 10%, which equals plus 4.
Positive 4. Since it's positive, sporting events are a normal, good, and the 4 suggests it's quite sensitive to income changes.
Yes, a coefficient greater than 1 for a normal good often indicates it's something of a luxury or discretionary item. Demand increases more than proportionally as income rises. An income elasticity between 0 and 1 would suggest a necessity. Normal good demand rises with income, but not as fast.
Wow. Elasticity really gives us a powerful lens to understand market behavior and consumer choices in a much deeper way.
Okay, let's shift gears a bit. Moving from those micro-level mechanics to something broader, a macro ripple that, well, it affects everyone. Inflation. It's definitely more than just prices going up, isn't it? It has some really profound, maybe hidden impacts.
It absolutely does. Officially, inflation is a sustained increase in the general price level of goods and services across an economy over a period of time. Not just one or two prices, but the average level.
And the key consequence is about our money, right?
Yeah,
Purchasing power.
exactly. There's an inverse relationship. As the general price level rises, the purchasing power of your money at what each dollar can actually buy goes down. Your money simply doesn't stretch as far. So my savings buy less coffee, less gas, less everything over time. How does this affect different kinds of assets and debts beyond just my wallet?
This is where it gets really interesting and strategically important, especially for businesses and investors managing their balance sheets. We need to distinguish between monetary and non-monetary assets and liabilities.
Monetary versus non-monetary. Okay, what's the difference?
Monetary assets and liabilities are those whose value is fixed in terms of a specific number of dollars. Think cash, accounts receivable, money customers owe you, notes payable, money you owe. The dollar amount doesn't change.
So the $100 bill in my wallet is always $100.
Nominally, yes. But during inflation, holding monetary assets like cash is generally bad. Why? Because that fixed $100 loses purchasing power. It buys less next year. So inflation hurts holders of monetary assets.
Okay, holding cash is bad in inflation. What about owing money? Monetary liabilities.
Now, holding monetary liabilities like a fixed-rate loan or bond you've issued actually benefits you during inflation
Benefits you. Okay.
because you get to repay that fixed dollar amount in the future with dollars that are worth less in real terms, less in purchasing power than the dollars you originally borrowed. Inflation erodes the real value of your debt. It's a transfer of wealth from the lender to the borrower.
Wow, okay, that's huge. Borrowers with fixed rate debt actually win from inflation in real terms. What about non-monetary stuff?
Non-monetary assets and liabilities are things whose value isn't fixed in dollar terms, but tends to fluctuate, often with inflation. Think buildings, land, machinery, inventory, even some commodities.
So their nominal price goes up as general prices rise.
Generally, yes. The market value of a factory building or a piece of land tends to rise along with overall inflation. Because of this, these non-monetary assets offer reduced variability in their real value during inflation compared to monetary assets. While your cash is losing purchasing power, the physical assets you own are often appreciating in nominal terms, helping preserve their real worth.
So owning stuff is generally better than owning fixed dollar claims during inflation.
As a broad principle, yes. Stuff tends to hold its real value better.
How does this play out in the world of investments? How should people think about their portfolio, stocks, bonds, etc., when inflation is a concern?
Inflation hits different investments quite differently. Let's start with fixed-rate debt investments, like traditional bonds.
Bonds pay a fixed interest payment, right?
Yes, a fixed coupon payment, plus the face value back at maturity. Inflation is bad news here because it erodes the purchasing power of those fixed coupon payments and the final principal repayment. The real return you get is lower because the dollars you receive back buy less.
So standard bonds lose value in real terms during inflation. What about floating rate debt, where the interest rate adjusts?
Floating rate debt offers some protection because the coupon payments are usually tied to current interest rates, which might rise with inflation. So your income stream adjusts somewhat. However, the principal amount you get back at maturity is still fixed in nominal terms, so that part still loses purchasing power over time due to inflation. It's not perfect protection.
Okay. What about stocks? Equity investments. Are they a good hedge against inflation?
It's complicated. For stocks that pay dividends, unless the company increases those dividends significantly to keep pace with rising prices, the real value of those dividend payments gets eroded by inflation, just like bond coupons.
Okay, dividends can lose value. What about the company itself?
Inflation generally increases a company's costs, labor, materials, energy. To maintain profit margins, they usually need to raise their sales prices. But if consumers whose own purchasing power is also being eroded by inflation, buy less due to these higher prices, the company's revenues and profits can fall.
So costs go up, demand might go down. That sounds bad for stock prices.
It often is. Rising costs and potentially falling demand can definitely put downward pressure on stock prices. So stocks aren't automatically a perfect inflation hedge, though some companies in certain sectors might handle it better than others.
So if bonds and maybe even stocks aren't great hedges, what is? Are there investments that tend to do well during inflation?
Yes, this is where alternative investments often come into play. Real estate is a classic example. Property values tend to rise with inflation over the long term, and landlords can often increase rents to keep pace with rising prices.
Okay, real estate makes sense. What else?
Commodities are another major category. Things like precious metals, gold, silver, energy resources, oil, natural gas, and agricultural products, corn, wheat. Their prices are often directly linked to inflation. When general prices rise, commodity prices often rise too, sometimes even faster.
So owning raw materials can be a direct hedge.
It often is. Also, some more sophisticated investments like certain types of hedge funds or private equity might employ strategies specifically designed to protect against or even profit from inflationary periods.
Can you give a really specific example of an investment built to fight inflation?
Absolutely. A great example is TPS, which stands for Treasury Inflation Protected Securities. These are bonds issued by the U.S. Treasury.
How do they work?
Let's say a company's CFO invests $4 million in TPS that pay a fixed interest rate of, say, 1.5%, maturing in 3 years. Here's the key. The face value or principal of the TPS security is adjusted semi-annually based on changes in the Consumer Price Index, CPI, a common measure of inflation.
So the principal amount actually grows with inflation.
Exactly. If inflation is 2.5% in the first year, that $4 million face value is adjusted upwards by 2.5% to $4.1 million. Then, the fixed 1.5% interest rate is applied to this new, higher face value for the next interest payment.
Ah, so both the principal and the interest payments effectively keep pace with inflation.
Precisely. It directly protects the investor's purchasing power against inflation. It's a very direct hedge.
That's really clear. Okay, circling back to debt for a moment. You said borrowers with fixed-rate debt benefit from inflation. That still feels upside down to many people. Can you explain that real cost idea again with numbers?
Let's make it concrete. Imagine company XYZ borrows $1 million by issuing a 10-year bond with a 5% fixed interest rate. They pay $50,000 in interest each year. Now, let's assume inflation averages a steady 2% per year over those 10 years.
Okay, 2% inflation annually.
At the end of the 10 years, company XYZ repays the $1 million principal. But what is the real cost of that $1 million repayment in terms of today's purchasing power, after 10 years of 2% inflation eroding the dollar's value?
How do we figure that out?
We need to discount that future $1 million payment back to its present value using the inflation rate. The formula is future value 1 plus inflation rate number of years. So $1 million is 1.0210.
And the result is?
It comes out to approximately $820,348. So while they actually pay back $1 million in nominal dollars, the real cost to them in terms of the purchasing power they originally received is only about $820,000. Inflation effectively reduced the real burden of their debt by almost $180,000 over the decade.
That is a powerful illustration. Inflation really does silently transfer wealth from lenders to borrowers on fixed-rate debt. Amazing. What about the flip side for businesses, the impact of inflation on their future operating expenses? That must be a constant headache.
Oh, absolutely. For CFOs and operations managers, inflation creates ongoing challenges because it relentlessly pushes up the costs of doing business: labor, wages, raw materials, energy, rent, transportation, everything.
And they have to pass those costs on.
To maintain their profit margins, they generally have to try and increase their sales prices. But if they can't raise price enough without losing customers, or if they can't find ways to cut costs elsewhere through efficiency gains, their profitability gets squeezed. It's a constant battle.
Can you give an example of forecasting that cost increase?
Sure. Imagine a tech company's CFO looks at their current annual labor costs, including benefits, which total $28 million. If they project that inflation will average 2% per year for the next 10 years, that $28 million in labor costs will balloon to roughly 34,131,844 hours in 10 years, just due to compounding inflation. That's over $6 million higher.
Just to pay the same workforce, essentially, in real terms.
Exactly. So the company knows its prices for its software services will likely need to rise by at least 2% per year over that decade just to cover the increasing labor costs and maintain its current profit margin on that expense alone. It forces businesses to constantly plan for rising costs.
Okay, that really clarifies the pervasive impact of inflation. Let's shift gears now. We've talked about market mechanics, external forces like inflation. How do businesses actually navigate all this? How do they create their strategy, their game plan to succeed?
This is where strategic planning becomes absolutely vital. It's not enough to just react to market forces. Successful businesses proactively shape their path. They need a clear strategy to meet their goals, and a deep understanding of that whole macro environment we've been discussing is the starting point.
And a really common tool they use to get started to analyze their situation is the SWOT analysis, right? Strengths, weaknesses, opportunities, threats.
Yes, SWOT is a classic for a reason. It's a simple but powerful framework that helps organizations structure their thinking about both their internal situation and the external landscape. It forces them to look inward and outward.
Let's break it down. Internal factors first, strengths and weaknesses. These are things the company has some control over.
Generally, yes. Strengths are the things an organization does particularly well. Its capabilities, resources, or attributes, they give it an advantage.
Like what specifically?
Could be many things.
Hmm.
Strong brand reputation, cutting-edge technology, talented employees, efficient processes, good customer relationships, maybe a strong financial position, clear leadership, or even just a really strong company culture. These are the internal assets they can leverage.
And weaknesses are the flip side, the internal areas needing improvement.
Exactly. Weaknesses are internal limitations or deficiencies that hinder the organization's performance. Things like outdated equipment, lack of skilled personnel in key areas, poor internal communication, maybe high debt levels, inefficient operations, or a weak brand image. These are the internal challenges the company needs to address.
Okay, strengths and weaknesses are internal. What about the external factors, opportunities and threats? These are things happening outside the company.
That's right. These are factors in the broader environment that the company doesn't directly control but needs to react to or anticipate. Opportunities are favorable external conditions that the firm could potentially exploit to its advantage.
Like new markets opening up, or new technologies they could adopt.
Precisely. Or maybe changing customer trends that align with their products, favorable regulatory changes, or even competitors stumbling. These are external chances for growth or improvement.
And threats are the scary external stuff.
Pretty much. Threats are unfavorable external conditions that could potentially harm the organization's strategy or performance. Things like new competitors entering the market, unfavorable economic downturns, rising input costs, disruptive technologies making their products obsolete, stricter regulations, or shifts in customer preferences away from what they offer. These are the external dangers they need to navigate or mitigate.
To make this really concrete, our sources gave an example SWOT for a company called Diverse Company, which makes bottles and pumps. Can we walk through that?
Absolutely. So Diverse Company is an international firm serving three main segments: food, healthcare, and fragrance. Let's look at their SWOT. For strengths, they've built strong business relationships internationally, which has helped them gain market share. They've also been successful in boosting production efficiency, leading to better operating margins. These are solid internal pluses.
Good foundation. What are their weaknesses?
Their main weakness seems to be aging equipment for making bottles and pumps. It's older than the industry average, leading to significant repair costs each year. That's a clear internal operational issue dragging them down.
Okay, need for investment there. What opportunities do they see outside?
The big opportunity is the growing global demand for personal healthcare products, especially in emerging markets. They see this as a major external trend they can tap into to expand their market share, even though their current sales there are limited.
A potential growth engine. And the threats. What external pressures are they worried about?
Key threats include moderate barriers to entry in their markets, meaning new competitors aren't impossible. They also recognize they need to ramp up R&D investment to stay competitive, which is costly. Plus, potential future compliance and regulatory costs in different countries could squeeze their operating margins.
So, putting it all together, how would Diverse Company use this SWOT?
They'd use it to guide strategy. For instance, they might decide to prioritize investing in new machinery, addressing the weakness, while also focusing R&D efforts on healthcare packaging for emerging markets, seizing the opportunity, perhaps funded by the strong margins from their existing strengths. And they'd build contingency plans for potential new competitors or regulations, mitigating threats. It connects the internal reality with the external landscape.
That makes the SWOT framework much clearer. It's a starting point for strategic thinking. Now, beyond just a company's own situation, they exist in a competitive arena, right? Michael Porter's Five Forces framework is famous for analyzing that industry structure.
Yes, Porter's Five Forces is another indispensable tool. It helps businesses understand the underlying structure of their industry and what determines the overall level of competition and profitability within it. It looks beyond just direct rivals.
Okay, let's break down the five. What's the first force?
The first is the threat of new entrants. How easy or hard is it for new companies to come into this industry and start competing?
If it's easy to enter, that's bad for existing companies, right? More competition.
Exactly. High threat of entry means profits are likely to be competed away quickly. What prevents this are barriers to entry.
What kind of barriers make it hard to get in?
Things like needing huge amounts of capital investment upfront, complex government regulations or licenses, strong customer loyalty to existing brands, needing large economies of scale to compete on price, proprietary technology protected by patents, or even just established firms having a significant cost advantage due to experience, the learning curve. If these barriers are low, new players will jump in whenever profits look attractive.
Okay, threat of new entrants. What's the second force?
The second is market competitiveness, or the intensity of rivalry among existing competitors. This is often the most powerful force. How fiercely do the current players battle each other?
What makes rivalry more intense?
Rivalry heats up when there are many competitors of similar size, when industry growth is slow, so firms fight for market share, when products are very similar, leading to price wars, when firms have high fixed costs, pressuring them to produce at full capacity, or when it's expensive for a company to exit the industry, so weak players stick around and compete desperately. Intense rivalry drives down prices and pushes up costs for things like marketing and R&D.
A real dogfight. Okay, third force.
The third is the threat of substitute products. This is about products or services from outside the immediate industry that can meet the same basic customer need.
Not direct competitors, but alternatives, like taking the train instead of flying, or using video conferencing instead of business travel.
Exactly. Substitutes put a ceiling on the prices an industry can charge. If good substitutes are readily available, perform well, are cheap, and it's easy for customers to switch to them, the threat is high. This limits the industry's overall profit potential.
Okay, substitutes limit pricing power. Fourth force.
The fourth is the bargaining power of customers, or buyers. How much power do the buyers in this industry have to push prices down or demand better quality or service?
What gives customers more clout?
Buyers are powerful if they buy in large volumes, like a few big retailers buying from many small suppliers. If the products they're buying are undifferentiated so they can easily switch suppliers, if they have low switching costs, if they have good information about supplier costs and prices, or if they can potentially integrate backward and make the product themselves. Powerful buyers can squeeze industry profitability.
Makes sense. And the fifth and final force.
The fifth is the bargaining power of suppliers. How much power do the suppliers of inputs, raw materials, labor, components have to raise their prices or reduce the quality of what they supply?
So can the people selling to the industry dictate terms?
Yes. Suppliers are powerful if there are few of them relative to the buyers, if the input they supply is critical and has few substitutes, if their brand is strong, if it's costly for the buyer to switch suppliers, or if the supplier could potentially integrate forward and compete with the buyer. Powerful suppliers can capture more of the value, reducing the profitability of the industry they sell to.
So analyzing these five forces gives a company a real picture of their industry's attractiveness and the key competitive challenges they face.
Absolutely. It helps them understand the underlying drivers of profitability and where the competitive pressures are coming from so they can position themselves more effectively.
Okay, with all these forces swirling around, internal, external, or the five forces, how does a company actually win? What are the core competitive advantages they can build to outperform rivals?
That really is the million-dollar question in strategy. At its heart, competitive advantage is about creating more value for customers than your competitors do and doing it efficiently. The formula is basically value offered cost to create value. Firms generally pursue this advantage through one of two fundamental routes, or sometimes a combination.
Okay, what's the first route?
The first is cost leadership advantage. The goal here is simple. Be the lowest cost producer in the industry. Not necessarily the lowest price, but the lowest cost structure.
How does having the lowest cost help them win?
It gives them options. They can either charge a similar price to competitors and enjoy much higher profit margins, or they can strategically lower their prices to undercut rivals and gain significant market share through volume. Their efficiency is their weapon.
When does this strategy work best?
It works well when price competition is fierce, when the product is standardized or commodity-like, when buyers are powerful and price-sensitive, and when there are few ways to differentiate the product effectively.
What are the risks?
The main risks are cutting costs so much that quality suffers unacceptably, or competitors finding ways to imitate your low-cost methods, or technology changes making your methods obsolete. You have to stay relentlessly efficient.
Our sources mention Toys Only Company as an example.
Yes, the online toy retailer. Their entire model is built on cost leadership, offering a huge selection at the lowest possible prices, leveraging operational efficiency and scale online to undercut traditional retailers, especially for toys where price is often a key factor for buyers.
Okay, cost leadership is about being the cheapest to make. What's the second main strategy?
The second is differentiation advantage. Here, the goal isn't to be the cheapest, but to be unique in ways that customers value and are willing to pay a premium price for.
Unique how? Better quality, better service, cooler features.
Any or all of the above. It could be superior product quality, faster delivery, exceptional customer service, innovative features, a strong brand image, unique design, anything that makes customers perceive your offering as distinct and superior.
And people will pay more for that difference.
If the differentiation is meaningful to them, yes. The key is that the price premium customers are willing to pay must exceed the extra costs the company incurred to create that differentiation.
When does differentiation work well?
When customers value uniqueness, when there are many ways to differentiate the product, when few rivals are following a similar differentiation path, and when the firm has the skills and resources, like R&D or marketing,
Yep.
to create and communicate that uniqueness effectively.
And the pitfalls.
It can fail if the differentiation isn't actually valued by customers, if the cost of differentiating is too high, if customers decide they prefer a cheaper, simpler option, or if competitors manage to imitate the differentiation too easily.
The example here was Quality Bathroom Inc.
Right. Selling high-end, uniquely designed bathtubs with premium materials and features. They command higher prices because they successfully differentiate themselves based on quality, design, and luxury appeal to a specific customer segment willing to pay for that uniqueness.
So cost leadership or differentiation, are there ways to combine them?
Yes, some companies try for what's called a best cost strategy. This is a hybrid approach. They aim to offer customers more value for their money by providing upscale product attributes at a lower cost than rivals offering similar upscale features.
So not the absolute cheapest and maybe not the absolute most differentiated, but a really good blend of quality and reasonable price. The best bang for the buck.
Exactly. Think affordable luxury or high quality at a fair price. The goal is to have lower costs than your direct differentiation rivals, allowing you to undercut them on price for similar quality.
When does this work?
It works well when buyers are value conscious. They want good quality but are also sensitive to price. They find generic products unacceptable but aren't willing to pay top dollar for the absolute highest end differentiation.
What's the risk of this middle ground strategy?
The big danger is getting stuck in the middle. You might fail to be cheap enough to attract the pure cost-focused buyers and fail to be differentiated enough to attract those willing to pay a premium for uniqueness. You end up appealing strongly to no one. It requires very strong execution.
And the example was Walmart Inc.
Yes, Walmart uses its incredible scale and operational efficiency to offer low prices, cost leadership element, across a vast range of products, including many respected name brands alongside its own store brands, differentiation quality element. They aim to be the best cost provider for a very broad market, offering superior products overall at the lowest prices.
Okay, that makes sense. One last category, focus or niche strategies. What's that about?
Focus strategies involve targeting a narrow segment of the market, a specific buyer group, geographic area, or part of the product line, and serving that niche exceptionally well, using either cost leadership or differentiation.
So applying one of the main strategies, but to a very specific small group, not the whole market.
Precisely. Instead of trying to be broad, you become a specialist for a particular niche with distinct needs or preferences.
When is focusing a good idea?
It works well when the niche is large enough to be profitable, when it has good growth potential, when it's not crucial to the success of major competitors, so they might ignore it. And when the firm has the resources and capabilities to serve that niche effectively and defend against challengers.
And the risks of being a niche player.
The niche might shrink or disappear, customer preferences within the niche might change, or large competitors might eventually decide the niche is attractive and use their greater resources to invade it. You can also be too specialized.
The example was All-Star Baseball Gloves, Inc.
Right. They don't try to sell gloves to everyone. They focus only on the high-end collegiate and professional baseball market. They use a differentiation-focused strategy, making premium gloves with the best materials and specialized features tailored exactly to the needs of those elite players, charging a premium price within that specific niche.
Wow. That covers a huge amount of ground, from basic market forces all the way to these complex competitive strategies. What an incredible deep dive into how the economic world works and how businesses try to navigate it.
It really is peeling back the layers, isn't it? We've gone from that fundamental dance of demand and supply governing every transaction to the subtle but powerful ways inflation shifts the landscape, and finally into that intricate chess match of competitive strategy that determines business success or failure.
It all connects. Demand, supply, costs, competition, strategy, it's all interwoven. Everything we buy, the prices we see, the companies that thrive or struggle, it's all driven by these forces.
Absolutely. And understanding them isn't just academic, it has real practical value, which I think leads to a final thought for everyone listening.
Go on.
Given everything we've unpacked today, this whole journey from the simple demand curve to Porter's 5 forces and competitive advantages, how might you rethink things? Maybe your next big purchase, analyzing why the price is what it is, what substitutes exist, or even thinking about your own career decisions. What industry forces are at play? What makes a company successful?
Applying these economic lenses to our own lives.
Exactly. Start looking for these forces actively. Notice the pricing strategies, the competitive moves, the impact of substitutes, the signs of supplier or buyer power. Once you start seeing the patterns, you understand the economic world around you in a much richer, more informed way. It really empowers you.
That is a fantastic thought to end on. Become your own economic detective. Thank you so much for joining us on this deep dive into market influences and business strategy. Keep exploring, keep learning, keep diving deep.